Good day to all. This is the second part talking about acquisition and payment cycle, and this will revolve or involve completing the tests in that cycle with verification of selected accounts. First objective or stop is to recognize the many accounts in the acquisition and payment cycle, which has been discussed already in the previous chapter. So here are the accounts associated, for example, for assets, expenses, and liabilities. For assets, of course, resources owed by the entity from cash, inventory, supplies, PPE, intangible assets, then the prepayments. For expenses, items that are found on the income statement, cost of goods sold, the administrative and selling expenses, including property taxes. For liabilities, all payables and accruals. For objective two is to design and perform audit tests of PPE and related accounts. So for the classifications of PPE, which are already discussed exhaustively in Intermediate Accounting Part 2 or in IAS 16 Property, Plant, and Equipment. So here are the reviews for classifications: land and land improvements, buildings and the improvements, equipment, furniture and fixtures. For computers, normally they are part of office equipment, but for this classification, perhaps part here, but we've already understood and tackled this from our previous accounting subjects that computers would be part of equipment. Then automobiles and trucks, so our equipment also, but more on delivery equipment. Then leasehold improvements are discussed, and PPE item which or PPE items which are still constructed. But I understand that under the revised IAS 16 and 41 that property, plant, and equipment items which involves still to be constructed must be indicated or must be specified that they are for PPE items when constructed, or in other words, the intention or objective is for the construction of PPE items for such to be part of PPE. Otherwise, if the designation is different, then that would involve other classification. Next, equipment and related accounts. So for equipment, the related accounts would be the acquisition for the assets, and then the disposals or the retirement of such, perhaps because they are sold or they are no longer usable to the entity. Then also related to that would be the depreciation expense accounts. Debit and credit would be the accumulated depreciation, which would be increased by the current period depreciation and decreased by the depreciation accumulated relates to the disposal, and then also with a gain or loss on the disposal or sale of such PPE items. Next, auditing manufacturing equipment and related accounts would involve also ratios or getting certain percentages out of comparison of certain accounts. Then we also have to verify the current year acquisitions and disposals, ending balance in the asset account, the depreciation expense, and the accumulated depreciation ending balance as said in the related accounts. For the analytical procedures for manufacturing equipment, we have to take note that again, these ratios would get us possible misstatements. So example, if we compare depreciation expense by the gross equipment cost with previous years, we will be able to identify possible misstatement in the depreciation expense and accumulated depreciation. So normally the ratio, for example, if this is straight line method, would be constant. And how come there are changes? So in that case, would be able to diagnose if in case there are already retirements to the PPE or really there are errors on depreciation expense and the accumulated depreciation. Next, what about compare accumulated depreciation divided by gross equipment cost with previous years? So in that case, we would be able to check misstatement in ACDEP or accumulated depreciation. What about for the annual or monthly or periodic repairs and maintenance, supplies expense on small tools, and then similar accounts with previous years? It's possible that we are actually expensing amounts that should be capitalized. Because remember, if let's just say the repairs and maintenance items actually would increase the economic benefits embodied in the PPE, So such would actually be capitalized. That's our target. We have to examine those items. Next is compare gross manufacturing cost divided by some measure of production with previous years. One item for possible misstatement would be if equipment is idle or not used or unutilized, or equipment that was disposed of already was sold but not written off, so not removed in the books of the company. Next is in verifying current year acquisitions, we have to take note that the current year additions will have long-term effect or impact on the financial statements, most especially on the depreciation expense and accumulated depreciation. Then 7 of the 8 balance-related audit objectives, such as occurrence, completeness, etc., are used as a frame of reference. So just 7 out of the 8. Then such would be discussed later. Next, for balance-related detail tie-in, we have to take note of the relationship between the balances and the details. So current acquisitions agree with the master file. If we acquire certain PP items, such should be agreeing with our master file or record. So we put the acquisition schedule. So we have to add such again, then trace the individual acquisitions to the master file, most especially with the source documents or the statements available and the attachments. Then we have to trace the total to the general ledger just to check if they're actually balanced or they're actually the same and they are equal with each other, so that if unequal, we need to reconcile. Next will be for existence. So we have to make sure that all acquisitions in that particular period actually existed, or those that are recorded actually existed or occurred. So we can do this by examining vendors' invoices, which should be our evidence for the reporting of the asset and liability, as well as the receiving reports that we have received such assets, and we physically examine if such assets actually existed. So example would be PP items. Let's say the machineries or the furniture and fixtures and the buildings. So it's so easy to check for the existence or occurrence, assertion, or objective. Next would be completeness. We have to check if those transactions that actually existed have been recorded. So examine again vendors' invoices of closely related accounts to uncover items that should be manufacturing equipment. In fact, we've said that completeness would be involving starting from the source documents to the accounting record. So we look into the vendor's invoices to our, let's just say, journals and ledgers for the equipment and assets acquired. So that is to satisfy the completeness assertion, and you call that flow of checking as tracing. Then we review lease and rental agreements because we will never know if the lease is a finance lease, in which we would be able to actually consider such acquired or such rented assets as us or as ours. Then accuracy. For this one, we have to check if the amounts or values are correct, especially with the cost, together with the directly attributable cost and subsequent expenditures or costs, as well as for the depreciation method. So the net book value or the carrying value or book value of the PP items should be correct, as well as all the or those assets there are which are acquired. Then classification, so we have to check if certain assets acquired actually are properly classified. So if we talk about PP items, they are part of the non-current assets or long-term assets, in which that's second or next to the current assets found on the asset section, which is on the left side of the statement of financial position. So that's how we present here in the Philippines. And we have to make sure also that the accumulated depreciation is presented or deducted from the relevant cost of the PP items. So in that case, for classification, we have to examine the vendor's invoices for the related asset, closely related accounts, and again, going back to our rental and lease agreements for capitalizable lease. For cutoff, this is with respect to the period because we have to make sure that only those transactions and acquisitions of a certain period have been included in that period. Then we also have to check if the depreciation expense belongs to that period as well as the accumulated depreciation. So this includes reviewing transactions near the balance sheet date for correct period. Then the rights. For the rights, the client has rights to current year acquisitions because we're talking about assets. So clearly, this would show that the client has a right over such. And what is the evidence? The vendor's invoices. For current year disposals, these are the procedures that we can do. Review whether newly acquired assets replace existing assets, which is a possibility. Then analyze the gains and losses on disposal because normally if there is disposal or sale, we do not expect that the value of the owed, which is the carrying value, and the proceeds from the sale would be equal. So normally there would really be gains and losses along the way. And then review documents for indications of deletion of equipment. If there has been deletion, like for example, it has been removed from our file for those PP items that are still in use. So in that case, that's really a disposal. Then make inquiries. We ask questions about certain possibilities of disposal of assets, most especially if we can no longer locate them by physically checking such or examining such. What about ending balance of asset accounts? So in this case, we have to check if all recorded equipment physically exists on the balance sheet date. This is existence or occurrence, and all equipment owned is recorded, completeness assertion. What about for depreciation expense? This would result to accuracy in terms of consistency and correct calculations. For accumulated depreciation, that would be on the ending balance. So as stated in the property master file, which should be equal or which should be agreeing to the general ledger balance. And then also the accumulated depreciation in the master file is accurate. Third objective, design and perform audit tests of prepaid expenses. So we are done with manufacturing equipment or property, plant, and equipment. Prepaid expenses are prepayments in which they are basically advanced payments or advanced payments of expenses. So here are examples of audit of prepaid expenses items, meaning to be audited. So the prepayments, including also the intangible assets as well as the deferred charges or expenses which are deferred for the meantime, or all other prepayments of expenses. Then these are the related accounts, prepaid insurance, so including the acquisitions, the premiums, as well as the expense. And then once they're expense, they will transfer from, or such would transfer from assets to expenses. So credit to prepaid insurance, but debit to insurance expense. This would be part of the acquisition and payment cycle because remember, the prepayments are paid in advance, so part of payment. Then internal controls. For these particular assets, we should be checking about the acquisition, which is for authorization, and the recording should be separate. Then the register for the insurance, so the records and the expense portion. Then audit tests. We can do the following to be able to check potential or probable misstatements. If we compare the total prepaid insurance and insurance expense with previous years, especially with the expense with prepayment, so we'll be able to check if our expenses have been consistent because normally insurance expenses actually are based on the period, so periodic, just like depreciation expense. So in that case, if we say periodic, meaning to say the percentages of those years should be equal or at least close to the desired or the supposedly percentage. Then the ratio is compared with the previous years. And then the individual insurance policy coverage on the schedule of insurance obtained with the preceding year's schedule. So we look into the schedule listing all the applicable insurances and then we compare the individual with the schedule. Next, audit tests. We compare the computed prepaid insurance balance for the current year on a policy by policy basis with that of the preceding year. So this is the balance in the year at the end of the accounting period, and then policy by policy, not just the total compared with the preceding year. We would be able to check if there has been misstatements on the balances of each policy or policies. Then insurance coverage also, like the items for the insurance, or let's just say what are the items covered or what are the items as benefits in the insurance. So part of the coverage of the insurance would be the benefits. Review the insurance coverage listed on the prepaid insurance schedule with an appropriate client official or insurance broker. Then these are the balance related audit objectives. So existence and completeness would be for insurance policies in the prepaid insurance schedule, they exist, and then those that exist are listed. So as said, the rights should be for the assets, then the evidences would be the contract for insurance policies. Then accuracy, in that the amounts should be accurate and the details should tie up and agreeing with each other. They're properly classified as expenses and assets respectively, expenses for the expired portion, assets for the unexpired portion, and that the insurance transactions are recorded in the proper period. Next would be to design and perform audit tests of accrued liabilities. So here are our examples of accruals. So accrued expense items from payroll down to interest. For the related accounts, here are our illustration for accrued property taxes, for example, although this would be the same for other items for expenses, we just have to replace property taxes with the items of expenses. So for credit side, because this is accrual, which is liability, basically, and actually these are part of current liability. So current expense would increase the liability, that's credit, and then normal balance of expense would be debit. And then the payments would be on the debit side. Next, number 5, we design and perform audit tests of income and expense accounts. So we do analytical procedures or the ratios, as well as TOC and STOT, and the TDD. For analytical procedures, we compare the individual expenses with prior years to check if there has been overstatement or understatement of balances. Then, if we compare individual asset and liability with previous years, normally within the same industry, so also for the overstatement or understatement, well, for the balance sheet account, because now we're talking about assets and liabilities. But take note, because of the concept of articulation in which items on one financial statement would be connected to the other, such that any understatement or overstatement or reverse with the assets and liabilities would have impact on the income statement or vice versa. Then compare individual expenses with budget, so misstatement on the amounts of expenses and balance sheet accounts or items on income statement and balance sheet. What about for the gross margin percentage with previous years? So it's possible that there has been errors on computation of the cost of goods sold as well as the values of the inventory. Then what about compare inventory turnover ratio with previous years? How do we compute inventory turnover? That is cost of goods sold divided by average balance of inventory. So in that case, we would be able to check like how fast it is for the inventories to be sold. So that is the inventory turnover. If we compare that with previous years, for example, if let's say it increases, so if the inventory turnover increases its value, so meaning to say an indicator that there has been fast sales. So in other words, we are actually improving in terms of selling our products. So lesser inventories, but more on the cost of goods sold. But what about like there has been abnormal fluctuations of such, so resulting to misstatements of these two items? Then what about prepaid insurance expense with prior or previous years? So related insurance expense and prepaid insurance could be misstated. What about for other items for expenses, commission expense by sales? So also for the accrual of commission, the expense and accrual could be misstated. What about for individual manufacturing expenses by the total. This could have result to the expenses portion, especially for manufacturing expenses that are capitalizable or capitalized as cost of inventory. And then these would be part of the inventory, but one sold would be part of the cost of goods sold. So balance sheet accounts for the inventory and then expenses for the cost of goods sold. Now we have to take note that both tests of controls and substantive tests of the transactions will have, under concept of articulation, effect of simultaneously verifying balance sheet and income statement accounts. So this is the good thing here, in that the financial statements are interconnected and interrelated with each other. Also, we can analyze expenses further, such as repairs and maintenance, because it's possible that supposedly these items should be capitalized. They are part now of repairs and maintenance. So that's the point here. And then for rent and lease, again, this would either result to expenses or to assets as ours because of the finance lease agreement under IAS 16 leases. And then for legal expenses, in which the fair value of the services rendered, legal services, should be expensed immediately. Then for analysis of legal expenses, which is somehow highlighted here, so something of importance in this particular chapter. So we have here as an example of how do we analyze legal expenses. So on the first column, coming from three different lawyers, so we have the legal expenses. And then these are the legal expenses of our company that is audited, for the company that we audit. Then for the applicable periods or the details. So we have here the date and then the amount. So in this case, we'd be able to know how much really is the amount or value of the coverage. And then we'd be able also to verify the contract details as well as the values for accuracy assertion or objective later on, especially for the amortization of these particular items if prepaid, but then if immediately affecting that period, so the amount of expenses that would have impact on the income statement. Then finally, we have to check also the test of details of account balances for allocation concept. Because remember, we have to take note that several expense accounts result from the allocation of accounting data rather than discrete transactions. So in other words, this would mean that there are a lot of expense accounts in which they are not actually coming from individual transactions, but they are just allocated from certain accounting data. Example would be the cost of PPE items. The depreciation expense would be coming from the allocation of such under systematic and rational allocation approach or concept for the expense recognition. Depletion for the wasting assets or the mineral resources, and amortization for the intangible assets. So the expense accounts coming actually from the assets and allocated. Then also allocation of manufacturing overhead between inventory for the unsold portion and cost of goods sold for the sold portion would be the example also for the allocation. So those items that are found for cost of goods sold would be allocation from assets to expenses. All right. So hopefully you got this information right. Thank you very much for listening and God bless us all.